Is it time for the European equity market to outperform the US? Let's have a closer look. As we see in the chart, this outperformance of Europe has already started. Since beginning of this year, Europe has been significantly better performing on the equity market than the US equity market. Of course, in the short term, when the US equity market goes down, most other equity markets also drop, as we have seen early April. And the recovery since then has also worked on all equity markets. Nevertheless, over these ups and downs, you can end up with a significant outperformance of one market or the other. Over the last more than 10 years, we were all used that the US equity market was the one to outperform. You see it here in the chart. The bars are the relative performance. When the bars go to the upside, the US equity market had a better performance year than the European equity market. When the bars go to the downside, European equity markets have outperformed the US peers. As you see, over the last more than a decade, US equity markets had always had the better yearly performance. But this has left us with a problem. US equity markets have performed better over the last decade. One, yes, because the companies behind also were able to grow their earnings, what the companies make as a profit, faster than in Europe. In this respect, the outperformance on the equity market had been justified. But prices on the US equity market had been rising much faster than they were able to increase their earnings, which left us now with a US equity market that is much more expensive, higher price-earnings ratio than in Europe. So you have to pay much more for the same dollar amount of company earnings in the US equity market than in Europe. This leaves us with the next slide, which shows exactly this extra premium, this overvaluation that you are paying in the US equity market versus the European equity market. And again, it's natural for a faster growing market as the US to be valued at a certain premium towards Europe. That's the green area where you see on average you have to pay higher prices in the US than in Europe. Valuations tend to be higher in the US than in Europe. But it's a question of degree. You also see in this slide that this extra premium for the US equity market versus Europe has never been higher than in the recent period. Yeah, and we all know why, no? Because all these artificial intelligence stocks and IT, etc. stocks are all concentrated in the US equity indices. Which leaves us with an interesting example. The last time the US had a monopoly on those cool internet companies, tech companies, and investors were willing to pay up for this, which was 99, 2000. You see here in the same slide as before, I put a green bubble around it, that in the next 6 years then, situation normalized and the European equity market was able to outperform the US equity market for 6 years in a row. So where does it leave us now? I would still say as part of a broad, global, diversified equity market portfolio, of course the US equity market, which is the biggest one globally, has its place and these companies there as well. But in many indices, global equity indices, we see that the US has already a share of 70% or more. And this is pretty concentrated if you think how high the valuation starting value for the US is. So I personally would feel more comfortable if in my portfolio also European equity market has a larger relevant share to be well prepared for the next years, where this valuation premium in the US probably comes down a little bit. The same basically applies to equity markets in emerging markets, China, East Asia, but on this we will have a look next time. For not to miss this next time, be sure to subscribe to our channel, hit the bell and like us, and wish you all the best and see you next time.